Good afternoon. Thank you for joining us for today's webinar, where we'll talk just about some of the banking numbers here through the second quarter, and then we will focus on just some of the credit metrics as well. Just a reminder, we are in our traditional webinar format where you can hopefully hear me, but we can't hear you. So please certainly submit any questions to us throughout the presentation, and we'll take those at the end. We've had great response on our coffee talks. Perhaps maybe we'll have to change the format of this one in the future. But nevertheless, we will send out a link to today's recording as well as a copy of the slides we use and share those with you in an email that will follow up more likely tomorrow or the day after. My name is Sean O'Brien. I'm the president of QwickRate, and I'm pleased as always to be joined by David Ruffin. David, as you can see, has extensive experience with loan reviews and managing and assisting banks with credit. So we're, as always, delighted that he joined our team here to develop what we call IntelliCredit, and look forward to his presentation today. Let me make sure. Just a reminder, again, QwickRate, we've been at the non-brokered CD marketplace for over 35 years. More recently, and for many of you, you've become familiar with our QwickAnalytics solution, particularly focused around CECL this year. And then David, as we mentioned, okay, Barry can't hear me. David, can you hear me?
Yes, I can hear you.
Okay, all right. Yes, please, anyone else, let me know if you're unable to hear me. Barry, I apologize. Hopefully the audio will get fixed here shortly. Jen, thanks, says she can hear me. So I'm hoping the majority of you can, if not, I mean, hopefully everyone can hear me. We'll try to make sure we resolve any difficulties. As I mentioned, David joined our team in 2019 with Larry Poole and David Littleton, and now Greg Atkins, and a whole host of credit experts to develop IntelliCredit, where we do provide traditional third-party loan reviews, but also they've built a cloud application to assist with the loan reviews, but also if you want to use them for internal review, and there's a portfolio analytical solution. So again, encourage you to learn more about IntelliCredit. We're going to touch on just kind of what's going on with the economy. Again, really kind of just taking the perspective of not really taking a position, but really just kind of showing you the backdrop from which the Fed seems to keep reminding us about how they're moving on and moving forward. Certainly last year and throughout these, we talked about the fact that they weren't seemingly worried about inflation, and they certainly got it in droves here this year. So we've now, and they have clearly pivoted from, focusing more on employment as part of their dual mandate, and now have really focused their attention on the inflation that is certainly taken hold in the economy. We'll talk about the QCBI results for the second quarter. I feel like it's a little bit like the economy, right? There's good things and bad things. It's not as good as last year or the year before, but it's still pretty good. But we can certainly see some warning signs on the horizon. As I mentioned, David will give us an update on the credit metrics. As you can imagine, they're all still pretty good. I think he and I were speaking before we jumped on the line today, just, there's a growing sense that there's something out there. We don't really know what it looks like just yet, but, I think there's certainly, reason to pause, given, some of the economic backdrops that we face. And then we'll just tell you what we're up to with QwickAnalytics and IntelliCredit, and then certainly entertain any questions that you might have. Again, just a reminder, I always just take the position, I'm always going to try to understand the facts as best I can and kind of determine where we're going based on that. And I think we're living in a world certainly of uncertainties, increasingly uncertainties, which is somewhat ironic, given the amount of information that's available to us. But that's what the Fed, kind of continuing to do with their position about being data dependent. They're really managing probabilities. And since they only have, a couple of tools in their toolbox, right, they're trying to do things gradually, which, again, kind of got us into this arena with the inflation we have. But I think now that we have it, they're kind of applying the same metrics and tools and saying, hey, we're going to move gradually because we're afraid if we move too fast, we'll throw the economy into a recession. That may be ultimately where we end up anyway, but they're going to take us there gradually with the hope that they can, thread this extremely, thin eye in the needle. And I think it's important, as I was thinking about this today, and I don't know if any of you play fantasy football, but I've played fantasy football with my high school friends for 30 plus years. And I was reading an article over the weekend where one of the, quote unquote experts was talking about a quarterback, and he listed out a number of different metrics about him. And then he listed out similar metrics or another set of metrics for quarterback B, and he posed the question, which one would you want, quarterback A or quarterback B? And he had presented the information. And the answer was they were the same guy. And his point is that with as much information that's available to us now in really virtually any realm today, you can build or support an argument to defend or support a position that you wish. And I think when it comes to the economy, that's kind of where we are, right? If you want to make the case that the economy is terrible, you can point to inflation and the volatility in the stock market, and you can make the case that things aren't very good. The flip side is you can look at last month's jobs numbers and saw 528,000 new jobs and make the case that the economy is still not that terrible. And so, I look at the Fed and I think they have in some ways not only a difficult task, but also in some ways just an impossible task, right? Because, they certainly have a wealth of information, but the bottom line is, they're probably never going to make everybody happy. At best, they might make 50% of the people happy. And so as I was, thinking about this presentation all weekend, I was thinking, boy, I'm thankful that I'm here talking about what the Fed has to do rather than being at the Fed and having to do what they're doing. So, again, I think it's just a reminder that, the Fed has a tremendously difficult dilemma, right? Again, do they act aggressively to retain credibility, with inflation and potentially derail the recovery of the economy? Or do they go slow and, play catch up to inflation, which is certainly the path that, they've taken here. And now, again, they have to determine how they're going to try to, kind of keep this thing on the track. So nothing easy. They have indicated that they'll remain data dependent, which again, I think means gradual, means being late, because you're always kind of waiting for the data, right? So you're always kind of in the wake of the data, which means you're probably going to be behind the curve. They seem to be comfortable with that. It certainly, again, brings a lot of criticism, but, I think there's no question at this point, they're going to continue to raise rates, but they're going to continue to do it gradually in the hope that they won't, completely throw the economy off the tracks, and that it'll be a gradual slowdown that may be, more manageable for people to weather. Interest rates are clearly going higher. Fed funds rates are going to go higher, and that obviously has should have the impact eventually of slowing down the economy. It certainly has slowed it here the last couple of quarters. The question is how slow, how big of a break or drop will we see? Just a reminder, again, the Fed has two mandates. Again, I think they get saddled with the idea that they can do a lot more than they can, but their focus is supposed to be on employment and inflation. For the last 5 or 6 years, employment had clearly been the issue, particularly after the pandemic, and that focus has clearly shifted as inflation has taken hold in the economy. And then I guess the other thing that I was saying is that, kind of going back to my point about the difficulty of the Fed and data, is that more than one thing can be true, right? The economy can be stronger than we think and maybe not as bad as we think, yet clearly recognize that inflation's a problem, right? It's impacting households across the country, but it's, again, I guess the old adage says, right, it could always be worse. And so, I think the Fed's trying to make it so it's less worse, if that makes sense. Again, being data dependent is not easy because you do have conflicting signals, right? If you look at a lot of the leading economic indicators and the yield curve, right, those in the past have been precursor or harbingers of recession suggestions, and they would certainly right now suggest that's where we're headed. The leading economic indicators are down nearly 2% over the last 6 months. Most of the yield curves, whether it's 2 to 10s, whatever range you want to look at, most of those now, or more than half of those, are inverted. Again, suggesting a recession is fairly imminent. Yet you had the July jobs report where 528,000 new jobs were created, which stood in the face of this weakening economy. If you look at the Wall Street analysts, they have not backed away from earnings growth, which again you would not imagine if the economy was going into recession. They continue to point to double-digit earning growth for a lot of the companies they cover. Wages continue to grow stronger, right? Up 5%. Again, how do you want to look at that piece of data? Great for employees and workers getting more money, but if you're looking at inflation and taking hold, that's certainly going to support that argument. So again, depending on what side of the coin you want to take, a lot of this data is good for some and certainly bad for others. Fed funds, futures are certainly pricing an increase. Actually, I think it's up to 3.8. I think I had a typo there. And then the inflation rate is still, hovering at about 8.5% annually. So, I don't have the faintest idea what I would do if I was the Fed, but, they again, watching what they're doing, they're clearly going to continue to raise rates until they slow the economy and try to get this inflation number down. It's probably a 2 or 3 year process to get it back into the range that they want. So I think we have to recognize that we'll probably live with a little bit higher interest rates and a little bit higher inflation than we've been used to over the past decade. So this chart was what I showed last quarter, and at the time it was suggesting the Fed's estimate of Fed funds futures had the market or Fed funds rate going to 275 by the end of the year, and now it's 380. And then the expectation is that somewhere in 2023 it will begin to drop down as we move into 2024. So again, I think these are being data dependent. The Fed is going to reserve the right to change their mind. Certainly the Fed governors are going to do that. Certainly the market's going to continue to do that. And I think we just have to be prepared for the fact that, since they're data dependent, we're going to have to be data dependent, right? We're going to have to wait and see. But I think clearly the path that's moving forward right now is higher rates until inflation really starts to roll over in a meaningful way. Again, the two tools that they're using to kind of combat inflation is raising the Fed funds rate, which they can do, and then reduce the size of the balance sheet. Again, to the idea of them being very gradual, if you look at the size of the balance sheet, it's not moved a whole lot. So while they've said they're going to begin shrinking the size of their balance sheet, I think, again, trying to be gradual, they're doing this at a really slow pace to try to mitigate some of the impact of the higher interest rates that they're controlling at the front end. So again, difficult job. They're trying to be as gradual and even in a tightening situation, being accommodative, I guess, if that's possible. These are some of the notes we talked about last quarter that came from the Fed minutes, and still kind of remain the same. Labor demand strong, wages are strong, aggregate demand is strong, right? The Fed can't control the supply chain issues. All they can do is try to dampen demand with the higher rates, and that's what they have been doing. And to this point, right, I think they feel like their gradual policy is working because the economy has remained fairly strong and able to handle the higher interest rates. Now, at some point it won't, but, again, I think it gives the Fed at least the confidence right now to continue on this gradual pace that we have seen. So for us, at the community bank, I think a lot of the implications remain the same as last quarter. I think we saw, and many of us probably experienced, we've still seen pretty good loan demand, particularly at the larger banks. Maybe some of our community banks, not as much, but, the loan demand has stayed pretty good. Yields are down, funding costs are down, but that means, in aggregate, NIM has been down, which we'll talk about, which again is a troubling sign. Last time I talked about that typically when the Fed raised rates, it usually occurred over a 12-month period. This time it certainly appears we're going to go longer than that. So we'll continue to monitor that. The inflation, we asked about how much more can the consumer take. We really haven't seen it destroy demand in a meaningful way. There's certainly pockets of where that's occurred, but for the most part, like I said, I think the Fed's going to continue in the path they're on because the economy has kind of absorbed these interest rate hikes, so far in a non-disruptive way. I think increasingly as we talk to banks, the impact on the securities portfolio, hasn't really been felt. But I think as we move forward, I think we probably have to start to look out to next year and see if this will impact our liquidity at all, because obviously if those remain underwater for many of us, we will not really have that securities portfolio as a real source of liquidity, because we won't want to turn those unrealized gains into unrealized losses into realized losses. So, I think that's certainly something to monitor to make sure you're okay with liquidity if you can't access, your securities portfolio. While I'm certainly not suggesting this or hoping for it, increasingly I think, you hear economists and forecasters talking about, some type of downturn in 23, later in 23 or 24. We'll have to wait and see. CECL, as we all know, and I think, for a lot of you who are working with us, thank you. It's upon us. So I think, we're assisting a lot of banks getting ready for this, but, the time is here, and that is quickly approaching. And then again, I think, it remains a challenge for a lot of us to price in our loans and deposits. I think fortunately for a lot of us, we sat on a lot of liquidity. So we have been slow to raise our local rates, but we do increasingly talk to banks who are starting to see a lot of their deposits run off and run out to higher yielding offerings elsewhere. So, again, 18 months ago, 2 years ago, 3 years ago, we were awash in liquidity, but for a lot of banks, and we've seen this at QwickRate, it's slowly turning again, right, in a gradual way, but we are, seeing an increase in the number of banks who are now beginning to, not have issues, but they're certainly starting to feel some liquidity pressures. So let's just talk a little bit about the 630 numbers from the QCBI. Again, this is available to all of you if you're a QwickAnalytics subscriber. On the homepage, in the data and research area, you can see these numbers both at the state and national level. We are, sadly comfortable under 5,000 banks now at 4821. The breakdown, again, kind of continually 2 out of 3 banks are under 500 million, but hold only about 19% of the banking assets. Asset growth still pretty good at 5% over the last 12 months. Again, in the lower chart, you can see a little bit more of that sloped line where we see a lot of it being realized by banks between $1 and $10 billion, more so than the banks, under $250 million. So, again, a variable to watch to see, how, if we do have any reductions, where those are most impactful. David's going to talk about loan growth, so I'm not going to spend a whole lot of time about this, but other than just noting the barbell here, right, where you have 31% of the banks growing fast or had loan growth over the last 12 months of greater than 10%, and yet we had almost 30% of the banks, have negative loan growth or no loan growth. So an interesting barbell effect there. Deposit growth, again, while we touched on it, we have been seeing an uptick in the banks with some issues. It's still pretty good growth over the last 12 months and really being realized by banks of all sizes. So, a little bit more off one-off stories, but we are beginning to see those. The yields, right? I mean, this is really where it starts to come into play for us, right? We had another, 33 basis point drop at the median for yields on loans for banks. we had a little bit of an improvement in cost of funds of 6 basis points at the median, but now we're at 321 for a median NIM. So again, half the banks in the country are operating with NIMs under 3.2%. As really our business model is being a NIM lender. This increasingly is challenging. I think I mentioned last quarter here in Illinois, NIM was under 3% for the Illinois banks, and so this is something that certainly is concerning. Not only because we're getting under 3, but to date we really haven't had meaningful credit issues in nearly a decade. So it just does really potentially make you pause and make sure we're doing everything we can to keep our portfolios as clean as possible. Non-interest income down, not surprisingly, right? This is meaningfully impacted by the rise in mortgage rates, and then the efficiency ratio has ticked up 0.5% at the median. All this means pre-tax numbers still really good. The median pre-tax ROA at 116. Again, to the right, you can see it's skewed to the banks, the larger banks. Core operating earnings in the same way, down a few basis points, but still pretty good, but certainly skewed by the size of the bank. Median ROA at 91 bips. Median return on equity, average equity at just slightly over 10%. But that same slope is occurring here, both for ROA and ROAE, right? So, the 1 to 10 billion banks make, almost double at the median of what the 0 to $100 million banks are. Okay, so at this point, I'm going to turn it over to David, and he's going to walk you through the credit metrics. There's a quick question, David. I'm going to see if I can get this. Yes, we will share the slides after the presentation. There'll be an email that comes from QwickRate that has a copy of both the slides and a link to today's recording. So, okay, David, the screen is yours.
Great. Well, always a pleasure to share the program with you, Sean, quarterly, and certainly the audience as well. As has been the kind of the tradition on the credit, we start with the metrics, and this interestingly enough, the divergence regionally, as you can see, the color codes among the regions, and again, our metrics are capped at $10 billion because that tends to be our marketplace, the community banks under $10 billion. So we are looking at the kind of pre-pandemic diversion that was existing regionally on NPLs to loans, which I call the inventory of acknowledged problems, which admittedly are very, very low at this point, has basically narrowed and if not collapsed. Same as is the case, of course, with charge-offs. They're basically non-existent and have no distinction whatsoever in terms of any region. Similar to has been going on several quarters in a row is we've been bookended by the the West having the larger amount of reserves to their loans, up to a little over 1.5%. The Northeast traditionally has been the lesser of the regions, and they're coming in at about 113 basis points. The inverse of that, of course, is to just say how much of our problem loans or acknowledged inventory of problems are being covered by reserves. Again, the West is a bit outpacing the rest of the country in over 3.5 times. And again, this is strictly reserves, doesn't have anything to do with all the additional capital cushion that we have had since Dodd-Frank. And again, this, as I said, I think last quarter, somewhat heresy coming from a credit risk guy. If you were looking at trying to take a little more risk to grow the bank portfolio, at least in theory, you could say Western or Pacific Coast banks would have a little more wiggle room to do that because they've got more reserves in place. And obviously, again, not even to talk about the capital cushion. In terms of our traditional concentrations that we tend to look at, again, these are guidances, not regulations that came forward about the mid-2000s. You see to the right the broader CRE to risk-based capital, which is a 300% guidance. And you do see, again, the West does lead the regions in that. The Midwest is somewhat the laggard in exposure to CRE. The subset of that, which is the 100% guidance, that's the chart to the left, which is the construction and development loans to risk-based capital. Not surprisingly, the Southeast and the Southwest and the Southeast lead in those categories because typically what you would expect in that is that these would represent regions that are appreciating demographically, in other words, influx of people moving in, and therefore the opportunity to have additional construction and development. 252 banks exceed the 100% guidance nationally, and 301 exceed the national guideline, or nationally exceed the 300%. Again, not a regulation, but it certainly would behoove banks that do exceed those figures to be able to be explaining their comfort level to have exceeded those guidances. Other typical concentrations we look at, not surprisingly, the Northeast would lead in multifamily. The mid charts shows some settling down in a more normalized C&I activity. Of course, the blip during the pandemic was, of course, the PPP program and its effect largely on C&I activity. And not at all surprising, the Midwest does lead in ag and farm loans to risk-based capital. Again, this is not inclusive of Farm Credit System. This is strictly the commercial banking data. Sean alluded to loan growth, and again, this is really a highlight of, I think, the second quarter to me from a credit standpoint. Again, sounding a little bit out of character for a credit risk person to, I've been saying for several quarters now, we really are dealing with a problem in the community bank industry in terms of the tepid loan growth. It's not sustainable. The investment bankers have been kind of pounding the commercial bankers on that issue, that you can't have this kind of almost flat loan growth over a long period of time and really sustain both your profitability and your valuation models as a bank. The good news here is obviously through the second quarter, a real big blip up in loan growth. And this, again, is shedding out all the effective. There's some residual PPP loans left, but it's not even worth citing, and we chose not to even reflect those this quarter. However, one of the heightened headwinds that we still face, and that is still that kind of reality that we're still lending, we being the commercial banking environment, are still lending against 50% of the economy is looking to non-banks to fund their commercial purpose needs, which is again adding to all the headwinds we have to face in terms of growing loan portfolios. And needless to say, most of those entities are either very minimally or not regulated at all. So that is certainly a headwind our industry still faces in terms of loan growth. But again, big win this quarter for loan growth. Again, I've said this also many times, and I probably can say it genuinely given the time I've been in the industry, but credit quality remains at generationally high levels. Never have I seen it this good, and that continued, not surprisingly, continued into the second quarter of 2022. But it does, as Sean alluded to, it does kind of beg that question, are we in somewhat of a calm before the storm? And so let's talk a little bit about that. Why is there any concern? Well, reserves are firming. I think that certainly shows that irrespective of the stellar performance in credit quality in 2020 and 2021, there does appear to be at least some firming in reserves, and irrespective of these very benign credit metrics, which I think reflects the wisdom of the industry and leaders in the industry to realize that there may be some bumpy waters ahead. Again, as Sean has certainly said and laid out in a very demonstrative way, we're dealing with almost record-setting inflation and a rate increase that hasn't been seen in a long time. We all know that those have linkages to weighing down on credit quality. There's a difference, however, I think, between 1980 and 81 and now, and I can speak to that because I do remember when prime got sent all the way by Paul Volcker to 21% in 1981. The real difference, I think, though, is the fact that in that period of time, the Fed was not only the big elephant in the room, it was largely the only elephant in the room. We arguably now, the Fed is also competing with a much more worldwide dependent international kind of economy that is really not in any way totally dominated by the U.S. So whatever attempts that are being made by the Fed to tackle inflation, it doesn't quite have the impact, I don't believe, that it had in 80 and 81. I do think, and I completely agree with Sean's point, they basically seem to be throwing the sink at fighting inflation. Again, we all know that the counter to that is it probably will weigh down on credit quality. And again, given the reserves, given the capital cushion we have, you could argue that that makes rational sense from the Fed standpoint. In other words, we can endure a little bit of more credit stress to just ultimately find a way to tame this runaway inflation that seems to be affecting so many people. My biggest concern, as I said last quarter, is that at the slightest uptick in some of this credit risk, I do fear a little bit of overreaction from both the investor community and the regulatory community. There is clearly an issue that we're seeing in the IntelliCredit world, because we deal so intimately with community banks and their loan review, and their annual review work, and their attempt to try to oversee credit risk at the individual banks. And what we're seeing is a major emergence of what I call operating challenges for community financial institutions. Things like being able to keep support teams that are often dedicated to managing credit risk, doing analysis, doing spreads, being part of the credit risk or the credit department. This is an area that seems to be, has been a real problem through salary inflation and just being able to recruit and retain talent in that. And all the while against a growing regulatory expectation for even more compliance and more risk oversight, particularly if we get into a little more quantifiable credit stress. Good loan growth, as I said a moment ago, what a welcome sign to see that growth pop up. But we all know, and this was one of the bitter lessons we learned from the last financial crisis about 12 years ago, was that loan growth late in a so-called benign credit cycle almost always produces a little bit more of a sour vintage. And we have to be aware of that and have to keep our eye on that particular area. You know, experts, I think it was an article just in yesterday's CNBC, indicated that they feel like we're already in a housing recession. So it, again, totally opposite of where we were last crisis, because we had an abundance of inventory. In some ways, we have a reduced inventory of that now. But the reason housing is important is because it has so much interrelated aspects in terms of furnishings and also creating households that have a lot of impact in the broader economy. There does seem to be an industry-wide sentiment that there's almost certain credit stress ahead. No one, you know, the last thing I ever like to be accused of, having been a credit risk professional, is a doomsday predictor who knows at all what a year from now or 2 years from now. But it would be very difficult to think that we could maintain these kind of benign credit metrics deep into the next couple of years. So let's take a look. One of the things that I felt very, very interesting that I read in the last couple of weeks was the FDIC's 2022 credit risk review by segment and market. Overall, it was clearly discussed. The thread that's going to run through each one of these segments is even the FDIC's acknowledgement. I've used the term government largesse in the past quarters. They used the term government support, has basically run its course, and that as businesses and individuals kind of wean away from that, inevitably there's going to be some weakness and downturn, and that the FDIC fully embraces that. So while there's been, again, stellar performance in the economy in 20 and 21, far better than what anybody anticipated at the advent of COVID, there is a acknowledgement that we may be in for some rougher times. Ag is actually one of the strongest. This is a roller coaster industry that has clearly, I've again been around. I was around as a lender and a credit approver in the mid 80s when ag had really a torturous situation to deal with. We looked like we were heading in that direction about 2017 and 18, with all the trade wars and tariffs and so forth. It has come back significantly, and a lot of community banks that have a tremendous amount of ag lending have done extremely well. There are some supply issues. The biggest single issue in ag, of course, is getting product to market. That again continues to be a worldwide issue around supply chain. Much of it, affected by the COVID environment. CRE is clearly an interesting point. While again, CRE seemed to have recovered, particularly in 2021, from some of the weaknesses that were being observed in 2020. There is a high degree of caution that is being uttered by the FDIC, and there's a specific thing that I think is related to community banks that is worth mentioning here. Community banks increased their exposure to CRE lending just in the last 10 years, in the last year on year by 10%. And that has risen now to 31% of all the CRE in the country. And that one thing that was really a wrinkle that I didn't anticipate was that community banks that are domiciled in rural and non-urban areas now have approached 65% of their loan book in CRE. Now, what that begs for concern is that all of this, of course, is brick and mortar. We do know that the entire paradigm of retail commerce is being challenged by, e-commerce, and we certainly knew that the community banks basically financed the great bulk, if not 90 to 95% of the so-called Class C and Class D retail space. But that number still was surprising to me. But again, CRE is something to keep an eye on, perhaps more of a long-term potential risk issue than a short-term. Consumer predictably was a concern of risk. Again, it's not showing up yet. Consumer balance sheets still remain strong. Spending power seems to be, for the most part, still there, although showing some signs of weakening. But again, the FDIC has a good bit of concern longer term for the inflationary impact, particularly on the spending consumer. Energy, again, is not a big direct exposure, of course, to community banking, but it's the ancillary. Again, a roller coaster effect to some degree, further exacerbated by the Ukraine-Russia war. And again, a sense that, okay, keep an eye on it in terms of how it affects. We know gas prices, for example, have been going down, but have shown just a hint of going back up, perhaps in the near term. Housing, again, the term housing recession, there's a lot of concern that this is an area that could be somewhat weakening. Again, the characteristics of housing now totally different than they were in the last financial crisis. Corporate debt and non-bank lending, again, are not necessarily the exposure so much of community banking, and at this time seems to be doing well, but again, heightened concern by the FDIC. The one area that was undoubtedly the most concern for the FDIC was small business lending. And you know, and I know that there's a lot of that is done at the community bank level. And again, a lot of that was on the premise that this segment has really benefited from a lot of the government support in the last couple of years that clearly they're having to be weaned off of. So I do think that was an interesting kind of visit on where the FDIC's perspective of credit risk may be, and hopefully that would be of interest to you individuals in the audience today. So why do we have need for what I call credit risk defensive strategies? I think that's really the better way of approaching it, because it hopefully girds us from unanticipated shocks, but kind of keeps us aware that these stress levels may be a little higher than what we've been used to in the last few years. I do think we need to adopt a more granular portfolio analytic kind of reconnaissance. Again, totally unlike the 2008 to 2012 financial crisis or the Great Recession, where arguably only one industry dominated, one to four family, all things one to four family housing seemed to dominate our drag into a recession and our crisis. Far differently than that, we've got to be on the lookout for a whole scattering of potential hotspots in our portfolio that may still be trying to recover from the impact of COVID and just dealing with the entire revolution that's going on in terms of e-commerce and our digitized world that we live in now. You do need tools, in my opinion, to be able to drill down to suspect borrowers immediately from any kind of trends that you see. And again, I say this in almost passionately, you can't wait for call report data for this kind of information. Those horses have already gone out of the barn. You've got to jump on early detection, early emergence of trends that are embedded within your own idiosyncratic loan data that will give you a first hint of credit stress. And we all know, those of us in the credit risk management business know, there's a deep and distinct correlation between early detection and reduced instances of losses. I do think more stress testing is going to be in order, even though I would argue that probably most of you on this call today aren't even required or mandated to do stress testing, but it's certainly in the vernacular of more and more of the regulators. I would argue that, you know, in many cases and perhaps in most, portfolio level stress testing would be quite adequate. And just consider using loan level where it may be justified. For example, significant concentrations or significant industries you feel like are most particularly vulnerable to heightened credit stress. We're big advocates of even considering companioning a loan product specific stress test with your next loan review. For example, if you've got 150, 200 loans that are being looked at in your next loan review, take 30 or 40 of those that may be CRE related and do just a simple stress test concurrent with the loan review. I think that would give your management team, your board, and even the regulators a sense that you've made an honest effort to try to do you know, a reasonable and rational stress testing. Finally, I get to what is probably my most passionate, and that is you do have to, in my opinion, embrace an enhanced quality loan review going forward. We've worked with a number of banks in the last 3 or 4 months, and it is so obvious to me that even at the board level, they seem far more engaged in what the loan reviews are saying, what they're beginning to identify. They're taking it very, very seriously. And why that's important is I think you need to start expanding some scopes. You need to clearly look at more of a risk focus in the sampling. But perhaps most importantly is make sure that you've got experienced reviewers looking at this. If we get into credit stress, you are going to need your bank to have, as a loan review agent or vendor, someone who can persuade, frankly, your management team and even your board over the issues percolating or arising in your loan portfolio. And some of the less experienced, what I call quantitative skilled people, but they're not the qualitative skilled people, this may be a challenge for them to really fill those shoes as credit stress begins to heighten. I also think, of course, we need to finalize CECL. Obviously, Sean has been just totally dominated in many ways in the last few months in working with financial institutions on getting them ready and compliant with CECL implementation. But I think this is important because we're still dealing with an environment where there's virtually no losses. There's very little quantifiable losses to point to. So we're still highly dependent on the so-called qualitative environmental factors. remember, this is the list I'm showing you now that has come with the traditional ALLL guidance. And they are basically what people are used to. But remember, CECL brought in 4 other factors that you legitimately can use for your Q&E factors. I do think that's going to be an area that needs to be looked at. Obviously, some of that is kind of the warm calculation that many of you use. But again, I still think this is where a lot of the activity in your CECL is going to be for the next probably even a couple of years. Okay, Sean, I think that wraps it from my end as far as the credit metrics for second quarter, and I'll hand it back to you.
Great, thanks, David. Yeah, so I think, David made a great point. I'm going to pull back my screen. And I think we've touched on that with a number of our banks, with even a portfolio level solution. I think for Q factors, as David suggested, right? I think the future of Q factors, and you've probably heard me say this, either in a one-on-one or in one of our coffee talks, right? I think the future of Q factors are potentially, deriving and getting your arms around more of your loan portfolio's granular, information. And again, I think initially with CECL, right, as banks were constrained by their data, we got, we got this push towards the portfolio level solutions. But I think going forward, it's kind of like to me, an inexpensive insurance policy to start capturing more of that loan level information, so that, as David said, you can have those internal metrics captured in your portfolio or in the dashboard like we do in IntelliCredit. And so you can see potential migrations or see potential changes in the complexion or makeup of the borrowers in your portfolio in terms of, again, their condition, their ability to make payments, weighted average risk grades, all these different metrics that you could get your arms around. And those are probably better metrics to determine your Q factors than some of the ones that we, currently use today. So again, most of you, if your portfolios stay clean, you don't need it, but to me, it is a little bit of an inexpensive insurance policy to kind of write for yourself. And that's, again, one of the areas of focus that David and his team are working on with IntelliCredit and our portfolio analyzer. So just a reminder, again, we're doing a lot of different things here at QwickAnalytics. Certainly, again, we're very proud and thankful that we have over 300 banks who are using the service now, and certainly most of them are using it. Came to us because of CECL, but there is, as we remind everyone, a whole lot more here. So, certainly even for our subscribers who maybe haven't, meandered much out beyond CECL, there is a lot of great industry information, again, not only about your bank, but other banks as well. Industry data, the QCBI report that we reference here today, just tremendous amounts of information that you can easily navigate and take advantage of. Again, just a kind of an overview. We go through the regulatory tools such as CECL. There's interactive bank pages on every bank in the country, and then you can certainly create your own peer groups. David's team at IntelliCredit, right? Most of you are familiar with them now from certainly attending these, but they focus, on a couple of different areas. One, the traditional third-party external loan review, but then, as I mentioned, the area that we're, increasingly excited about are the cloud-based solutions that include the portfolio analyzer and smart loan review, where you can use the same tools we use for our third-party loan reviews in your own bank, and then there's also, the ability to do annual reviews. So again, certainly, I think the dashboards that come in the portfolio analyzer can be very instrumental in developing internal Q factors for the future. Again, I think our approach is, I think you've seen with CECL, is we've tried to build solutions that are affordable, that are easy to use, and then of course, we'll be here to support them, as we move forward. A reminder, we do have a couple of webinars and coffee talks coming up. The next coffee talk for CECL is September 16th, and then we will have a demo just on the CECL solver here at the end of the month on August 30th. Just a final reminder, if you have any questions, you can submit those now. If not, if we don't have any, then again, a reminder, we will send out a link to today's presentation along with the recording and the slides. And then, certainly encourage you, if you'd like to learn more about QwickAnalytics or IntelliCredit, schedule a tour. If you're, thinking about a loan review, we'd certainly love the opportunity to quote that. You can see firsthand, the tools that David's developed, and then, certainly have, his and our team's expertise available to you. So on behalf of David, thank you all very much for taking time out of your day. I know these are busy days at the bank. And so thank you again, and we will look forward to seeing you next quarter for our Q3 webinar. Thanks so much and have a great day.